Well done, sir.
Yeah, good evening, sir.
Yeah, good evening, sir. How's everything, sir?
Thank you, sir.
I was trying to solve the questions on variance analysis when we had that issue, So because variance analysis is very important to your syllabus. So I think the last time I discussed this from Lee, and I think I was trying to solve the questions. So please, quickly allow me to go through these questions again quickly before I move on to something else. Allow me so that before I move on to something else today. Now, look at it. Sleepwear PLC is a manufacturer of beds. So it means that company is a manufacturer of beds. I'm trying to solve these questions so that at least we have one question solved in variance analysis before we move on to something else. Now, Sleepwear PLC is a manufacturer of beds. It uses a standard absorption costing system to monitor performance of managers and departments. It means that company is into production of beds. And you are now giving information on the standard cost of that organization. Now, look at the standard cost of producing the bread. It means that when I say standard cost, it simply means that what is the standard they set to produce 1 unit of the bed. In the exam, that standard cost will be the standard cost of material, standard cost of labor, standard cost of overhead, variable, and standard cost of fixed overhead. And they will even give you the standard selling price. Standard simply means what you set to incur. Hope you are getting me now. So examiner will give you all what you set at the beginning of the period to incur in producing each of the products. Please notice what you set, not what you actually incur. Are you getting me now? Now, what you set to incur, that's the standard they set. Now, if you look at the standard they said they wanted to sell the products at 250. That's not what they actually sold it, but they envisaged that if they eventually produce, they will sell it at 250 naira. And the production cost now. For the production cost, they now said that the direct materials will be 12 meter at 150 kobo per meter. It means that for each of that bed, I set to use 12 meter. And that 12 meter, per each of the meter is 1 naira 50 kobo per meter. That means that 1 naira 50 kobo per meter times 12 meter is 18 naira is the cost of the material I set to use in producing each of the products. Direct labor, I set to use 4 hours at 6 naira per hour. That's 24 naira. It means I set to use 4 hours to produce 1 bed, and for each bed, I will be paying 6 naira per hour. For variable overhead, the variable overhead is measured in terms of hours now. I have 4 hours I set at 15 naira variable overhead rate. That's the rate of absorbing overhead, happens to be 15 naira per hour, which gives you 60 naira. While the fixed overhead also at 4 hours, we absorb it at at the rate of of 10 naira per hour. In a nutshell, the total cost I set to incur, but actually the addition of the 18 naira material, 24 labor, 60 variable, and 40 fixed. You add it to get 142, which is your cost of sales, but standard cost of sales. If I less the standard cost I want to incur from the standard selling price I want to sell, I'll get the standard profit I'm looking at making. It means that all things being equal, I'm looking at making 108 naira as profit. Now, if you look at it, budgeted production and sales are 1,000 dreamers per month. That's what I'm looking at selling in a month. It means that they budgeted that in a month, we are looking at selling 1,000 dreamers. That's 1,000 beds. Those are the standard information. They now give you the actual information. Actual information simply means what did they now actually incurred in the period. Let's look at it. What did you now actually incur in the period? The actual result for the manufacturer and sales of dreamer for the most recent month was as follows. The actual result is now we sold 1,200 at what? At 240 naira per bed. That means that for each of the bed, we actually sold them at what? At 240 naira. And we sold 1,200 beds. But we produced 1,300. In the exam, you should be wary of what they produce and what they sold. If what they produce is equal to what they sold, there will not be any closing inventory. But if what they produce is actually is not the same thing as what they produce, then there is tendency for closing stock. 200, that's what they sold. They sold 1,200, but they produced 1,300. If I produce 1,300 of the product and I now sold 1,200, then there must be leftover of 100 units. That is closing stock. And you are given direct materials purchased and used. What do we purchase eventually? We purchase 16,000 meters at 1 naira 40 kobo, 1 naira 40 kobo per meters. And also direct labor, work and paid. This should be paid. Worked and paid will actually work 5,000 hours at 6 naira per hour. And the variable overhead are 75,500 and fixed overhead are 54,600. Variable overhead are 75,500 and fixed overhead is what? 54,600. Now, there were no opening stock of finished goods. There were no opening stocks of finished goods. So implication of it is that no opening stocks of finished goods. So therefore, you're now asked, you now compute the following variances. Now, required, calculate the following variances for the most recent month. So what are the variances you are asked to compute now? You are asked to compute direct material price variance, direct material usage variance, direct labor rate variance, direct labor efficiency variance, variable overhead expenditure variance, variable overhead efficiency variance, fixed overhead expenditure variance, fixed overhead capacity variance, fixed overhead efficiency variance, sales volume variance, and also sales price variance. You can see all those variances we talked about the last time were what they asked them to compute. And they now said you should prepare a statement reconciling the projected profit and actual profit. So let us quickly look at this using the formula before we go on to something else. Yes. Now, if you look at it very well, your material price variance. What is your material price variance? My material price variance simply means the difference between the standard price I set and the actual price I incur of the materials. That's your material price variance. So in the exam, if the examiner asks me compute these variances, one, material price variance. Immediately you hear price variance, you know that the variance you are looking for is the what? Is the price variance. That's the variances or differences in what's in the price you are buying the materials. I hope you are getting what I'm saying now. So variances, material price variance is the variance in the price. Now, it means that what do we want to buy and what do we actually buy? I guess what I'm saying now. Then the difference we are multiplying by the actual quantity of material purchased. I hope I get what I'm saying now. So let us look at it. What's the standard price? What's the actual price of material? You see things here, I'll pick it now. And I want you to follow suit. When they say standard price, where we go? You go to what? Standard information. That's where you see standard price. Look at standard information. I'm not saying selling price. Selling price is different from standard price of material. I guess what I'm saying now. The standard price of material, my network is already, sorry. Now let's look at this. What is the standard price of material? If you go to the standard information of the material is this. We use 12 meters, we said 12 meters at 1 naira 50 kobo per meter. It means that per meter, standard price of it is 1 naira 50 kobo. But what is now the actual price of material? The actual price of material, look at the actual information. If you look at the actual price of material is 1 naira 40 kobo per meters. That means that if I'm looking for my material price variance, I will just say material price variance is equal to what? 1 naira 50 kobo minus 1 naira 40 kobo actual price times actual quantity of material purchased. Because you want to look at the totality of that variance, but you look at it in terms of the actual quantity of the material purchased. Because if you look at what's the material they purchased, they purchased 16,000 meters. This is actual information. 16,000 meters. Therefore, so far they purchased 16,000 meters, then it should now be 16,000 into standard price of 150 kobo minus actual price of 140 kobo. That means that 1.5 minus 1.4 is 0.1 times 16,000. That is what? That is a 1,600 favorable. That means that it is not 600, it is 1,600 favorable. Sorry for that mix up. It is 1,600 what? Favorable. That's that. But if we now talk about material usage variance, it means that we are looking for what? The variance in the usage of the material. Usage in the sense that what is the standard quantity of material to be used and what is the actual quantity of material used. I hope you are getting me now. What is the standard quantity of the material to be used and what is the actual quantity of the material used. That obviously will give you what? Will give you your material usage variance. Let's go and check our standard quantity and actual quantity and see how we can pick our standard quantity of material and actual quantity of material. Standard quantity of material, you start from what? You go to the standard. Look at the material. What is standard quantity of material? Standard quantity of material. You set to use 12 meters to produce one of the products. You will not ask yourself, sorry, how many units of that product do they actually produce during that period? How many beds do they actually produce? You now go and check the actual productions now. If you look at the actual information, you see that in production, they now actually produce 1,300 beds. So what's the meaning of that? It means that they set to use 12 meters to produce one, 10 times. How many units you want to now produce? 1,000. That's 15,600. So that means that standard quantity of material that they use to produce the actual productions for the period is what? Is 15,400. $15,400. Can you see 12 times 1,3 is 15,400. But what's now the actual quantity of material? The actual quantity of material is now what? The actual quantity of material used, that you will get it from the actual information. If you look at the actual information, the actual quantity of material used is now 16,000 meters. Then you now say 15,400 divided by what? Minus what? Minus, can you now see? 15,400 minus what? Minus 15,600 minus 16,000. What's the difference? The difference is 400, right? Times the standard price. Don't forget the standard price of material the other time was 150 kobo. So you just multiply that 400 by 1. Usage variance is adverse. You're not using the material efficiently. That's why you have what? You have the adverse term. I guess me. That's material usage variance. Now the next one is labor rate variance. Now when I say labor rate variance, I'm talking about the variance between the what? The standard labor rate and the actual what? The actual labor rate. Okay, that's what I'm saying now. It simply means that how much are we looking at paying? How much do we set as standard to pay? And how much do we eventually paid? I guess what I'm saying. That is more of what? Of variance in what? In labor. Let's look at it. What is the standard rate of payment of labor? The standard rate of payment of labor is this. Let me check it. You go to the standard. This is labor. They pay 6 naira per hour. That's the standard they said to pay. 6 naira per hour. But let us now look at what's the actual hours they now eventually pay on labor. Look at the actual information. Now, direct labor, they pay 6 naira per hour. Can you see a coincidence now? Now, we wanted to pay 6 naira. We now eventually pay 6 naira. That means that if you are computing the material usage variance, if you are computing the labor rate variance, you now say what's the standard labor rate and what is the actual labor rate? The difference in the two, 6 minus 6 is what? 0. I guess what I'm saying now. Times what's the actual hour? Actual labor hours is 5,000 hours. That gives me the what? 0, which is the labor rate variance is what is 0. It means that there is no variance in what in our labor. I hope you get what I'm saying now. what we budgeted to spend on labor was what we actually spent on labor. Thank you. Now the next one is what? Labor efficiency variance. In the course of determining the labor efficiency, you are saying how many hours do we permit the workers to work in order to produce what they actually produce, and how many hours they actually work. Now, the next one is labor efficiency variance. It means that how efficient are the workers? To know how efficient are the workers, you need to measure their efficiency in terms of labor hours. In the sense that how many is the labor hours you are expecting to use, and how many labor hours you actually use. It means that how many labor hours do we envisage to use? That's our standard hours. And how many labor hours do we actually use? That's our actual labor hours. The difference between standard hours and actual hours, I guess I will give you whether they are efficient or not. That simply means that if the hour they eventually use, which is the actual hour, if it's more than the standard hour, then that is what? That is an adverse variance. It is an adverse variance in the sense that you are using more than what you wanted to use in hours. You're not doing well as a manager, as a worker. I get me now. That's adverse variance. But if the actual hour that they work is even less than the standard hour they decide to want to work, then that's a favorable variance because what? Because you are using an hour that is lower than hours that you say to work. So that means that if I'm looking for my efficiency variance now, now say standard hour minus actual hour. Now, how do I get my standard hour? Look at the way you get your standard hour. Go to the standard information, you see it there. This standard information, you now go to what? The labor. What standard labor hours? How much is that? 4 hours. But 4 hours simply means hours needed to produce one product. But don't forget, we produce 1,300. Then what's the standard hours to produce that 1,300? It will now be what? 4 times 1,300. That will be 4 times 1,300. That will be 5,200. That means that the total standard hour, based on what you actually produce, is 5,000 what? 5,200. So it means that in a nutshell, so far is 5,200. You now see 4 times 1 3 is 5,2. Then what's the actual labor hour? Actual labor hour we are given the other time. If you check the question, the actual labor hours are 5,000 hours. You can see this is actual information, labor hours 5,000 hours. Then that's what you will use in your computations. So if you are using that, it will now be standard hour is 4 times 1 3, 4 times 1 3 minus 5,000. That's 5,2 minus 5,000. That's 200 times 6, which is 1,200 what? 1,200 favorable. I hope you know the reason why it's favorable. Because the actual labor hours, which was 5,000, was less than actually the standard labor hours they envisaged. Now, let's look at the variable overhead expenditure variance. Variable overhead expenditure variance we'll be talking about the variance between what is the rate of our standard variable overhead rate. How much is the rate of absorbing the overhead, and how much is the rate we envisage to absorb it? Are you getting me? That's standard variable overhead rate. And if you want to get that, if you find the difference between the standard variable overhead rate, look at the standard variable overhead rate minus actual variable overhead rate. The difference there is what you multiply by the actual labor hour. Let's go and check the standard and the actual variable overhead rate. When I say variable overhead rates, those are labor, those are what? Those are the indirect cost overhead, variable overhead rate. Standard variable overhead rate Let's look at the standard, please. This standard. Variable overhead. How much is the rate? 15 naira. That was the standard. But actual variable overhead rate, you didn't give us the actual variable overhead rate. You are not giving, we are just giving the total 75,500. So let's us see how we compute it. If you are computing that, please. Now, variable overhead expenditure variance is now what? You know, we are actually talking about expenditure now. What is standard variable overhead rate? That was 15. What is now the actual variable overhead rate? You don't know. What do? You just divide the actual variable overhead cost by the actual labor hour. That will give you a rate. I hope you are getting it. That rate should be given, it should be 15.1. You now remove it from 15, which is 1.0, remove it from 15, 0.1 times 5,000, which is 500 hours. That means that the variable overhead expenditure variance will be 500 hours. The next one is fixed overhead. Are we following at all? Let me have your view. Are we following? Are we following? I want to know whether we're following. Okay. Oh, thank you for following. Thank you. Now, if you are looking for the fixed overhead efficiency variance, whenever in the exam you are looking at efficiency variance is what is just talking about what is the standard hours when we say to use and what's the actual hours we now eventually use. That's an efficiency. So if they now ask you to get the variable overhead efficiency variance, so efficiency in the middle will be standard hour minus what? Actual hour times standard variable overhead rate. What's our standard hour? Standard hour is what? 4 hours times actual production of 1.3. That gives you total standard hour. But actual hour is how much? It's 5,000. So the difference between 5,200 and 5,000 is what? Is a 200. Then 200 times 15 is 3,000 favorable. The reason why it's favorable is that the actual hours we use is not less than the standard hours it's supposed to use. That brings about what? Favorability. So variable overhead efficiency variance is what? Is 3,000 favorable. Now, fixed overhead volume now. You know, the volume is very circumstance. You need to look at the format I gave you. That format of SH minus BH, SH minus AH, and AH minus BH as a way of what of tackling this area of the. Now, let's look at it. So, if you look at it, based on what I explained to you another time, the format and all that, that's SH, BH, and AH. Let us look at it. Now, in that format now, we said if you are looking for your fixed overhead volume variance, fixed overhead volume variance is what? Is standard fixed overhead rate into standard hour minus what? Budgeted hour. How many hours do we budget to spend? And how many hours do you actually set to spend on what we actually produced? I guess what I'm saying now. And whatever you have, you multiply by standard fixed overhead rate. Let us first go and get standard fixed overhead rate and see whether it works. We know what we're doing. Standard fixed overhead rate, go to the standard informations. Standard fixed overhead rate is how much? 10 naira per hour. This is the rate, 10 naira per hour. So if we have standard fixed overhead rate to be that, to be 10 naira per hour, which is this. Then what's now the standard hour? Standard hour still remain 4 times 1,300 minus budgeted hour, which is what? 4 times what? Times 1,000. I hope you understand how I got my standard hour. Standard hour is determined as the basis of what is computed on what? On actual productions. And what we actually produce happens to be 1.3. Why budgeted hour is based on standard hour, standard productions or budgeted productions. So that means that we were able to produce 1,000. If you check it very well, we were able to produce 1,000. I guess in it. So and what they actually produce happens to be 1.3. So it means that I will need to multiply the 4 by 1.3, and then I will now subtract 4 by 1,000. I get what I'm saying now. So that will give me what? Whatever you give me multiplied by 10, which is standard fixed overhead rate, will give me 12,000. So fixed overhead volume variance in this instance is what is favorable. Please give me 1 minute, please. 1 minute, please. Let me just give me 2 minutes, please. You want to sort something there. Okay, so sorry. Now that's fixed overhead volume variance. So volume variance at all time, you find it by saying standard fixed overhead rate. That's the rate of absorbing fixed overhead. They will give you in the questions. Then you now say in bracket standard hour manipulated hour. Go and check the way we got standard hour. Standard hour we got it by saying standard hour per unit times actual productions. You are multiplying standard hour by actual productions here to get my standard hour. But when you're finding your budgeted hour, it is still the same standard hour per unit, but you now multiply it by budgeted productions, what we actually budgeted. Therefore, in the exam, a student want to ask me that is standard hour and budgeted hour, are they the same or not? I can say yes and I can say no. Yes, in the sense that at any point in time, if what they budgeted to produce is equal to actual productions, then automatically standard hour will be equal to what? Budgeted hour. But in a situation in which what they actually produce is different from what they anticipated to produce, what they budgeted to produce, then there is no wasted hour and budgeted hour will be the same. It will only be the same when actual production and budgeted production are actually the same. I guess you know. So that's that. Now don't forget that fixed overhead volume variance is divided into two: fixed overhead efficiency variance and fixed overhead what? Capacity variance. Now, it means that if you are finding fixed overhead efficiency variance, so we are actually looking at what is the variance in the volume. I guess that is due to the efficiency or inefficiency of the workers. I guess what I'm saying now. It means that what is the efficiency, what's the impact of the efficiency or inefficiency of the workers, or the work done, or the hours used on the what? On the fixed overhead absorbed. I guess or on the efficiency of the what? Of the fixed overhead efficiency, in the sense that if you want to look at fixed overhead efficiency, we're actually relating the hours, efficiency hours to what? To actual productions. I guess it means. So you are looking at what is the impact of efficiency or inefficiency of that labor, I guess it means, on the absorption of the what? Of the fixed overhead. Because fixed overhead is actually talking about over or under absorption of fixed overhead due to what? Due to volume of productions difference. I get it now. So that's that. So in the exam, if you ask to find the fixed overhead efficiency variance, it will now be standard fixed overhead rate into standard hour minus what? Actual hour. Don't forget, your standard hour is still premised on actual productions. That means that your standard hour per unit is 4 hours. Let's go and check it. Standard hour per unit is 4 hours. can see fixed overhead, standard fixed overhead is 4 hours at 10 naira per hour. That's 4 hours. Fixed overhead efficiency now, e now be standard hour is now 4 hours per one times 1,300 actual productions. Then you now compare with what the actual hours, they give you actual hours in the question, which is 5,000. So it means that 4 times 1,3, which is 5,2 minus 5,000, which is 200. Then 200 times 10 is what? 2,000. Favorable. I guess what I'm saying now, because favorability in the sense that what you set to use in hours, standard hour, is actually more than what you actually used in our actual hour. That's why we have 5,200, which is more than 5,000. I get me. So the variance is what is favorable. Now the next one, which is the last one that the volume, is what? Fixed overhead capacity variance. We are looking at the capacity of the organization, the impact of it on the world, on the organizations, I guess me, on the production or the volume. So it means that if you are looking for fixed overhead capacity variance, it's computed by saying standard fixed overhead rate into actual hour minus budgeted hour. And the question is that what is actual hour and what is budgeted hour? Actual hour is 5,000, while budgeted hour is what? Budgeted hour is still standard hour per one. 4 times actual production is 1,000, which is 4,000. So with this now, which is 1,000, and the 5,000 minus 4,000, coming. Actual hour is 5,000. 5,000 minus 4,000, which is 1,000. 1,000 times 10 is what? Is 12,000. Now, if you look at it very well, if you look at the efficiency variance and capacity variance, what was it? 2,000 plus 10,000, that's 12,000. That 12,000 now, you now place it here under the fixed overhead volume variance, which is 12,000. Favorable. Hope you're getting me now. That is that for that. So please note it. So addition of fixed overhead efficiency variance, which is 2,000 favorable, and fixed overhead capacity variance, which is 10,000 favorable. If you add the 10 and 2 together, give you 12,000, which is that of the what? Which is that of okay. Okay, you have a question? No, I already sent it, please. I already sent it. Okay, ask the questions, please. If you have a question, please ask the questions, please. You can send the question via the chat, please. Let me have your phone. Okay. 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 Are you done? Okay. Based on what you put in here now, you said what you are actually answering the question. I want to answer the question now. You said what you are taught in class is fixed overhead cost variance and fixed overhead expenditure variance. That's cool. Now, okay, no problem. You see here, you see the fixed overhead. It means that it's because the exam, the lecturer had done very nice job, fine, very good job. But you see, that fixed overhead variance, let me explain deeply a bit. Let me put it forward to you. If you are talking about fixed overhead variance, we are talking about over or under absorption of fixed overhead. I get what I'm saying now. Over or under absorption of fixed. They normally absorb fixed overhead into the cost of product. Now, sometimes we over absorb it. Sometimes we under absorb it. You see, if you over absorbed fixed overhead, it will drop the profit because what happened? The profit will go up. I guess what I'm saying now. So in a nutshell, in the fixed overhead variance, it is basically divided into two parts. It is divided into what? Into volume variance and what? And expenditure variance. I can see now. Fixed overhead cost variance is divided into two parts. The two parts are fixed overhead volume variance and expenditure variance. Now, that fixed overhead volume variance, it simply means over or under absorption of fixed overhead that is due to the what? To the volume difference. That's what you budgeted to produce and what you actually produce. That difference in that volume of productions, the impact on it on the over or under absorption of fixed overhead is what we call fixed overhead volume variance. But fixed overhead capacity variance, fixed overhead expenditure variance is talking about how much do we even want to expend in fixed overhead and how much do we actually expend it? What do you budget to expend in total? And how much do we actually expend? You see, that two variances now is the major categorization of fixed overhead. But you see, that fixed overhead volume is now subdivided again into capacity variance and efficiency variance. So if you're not taught that, if you're not taught, if you did not explain that to you in class, I want you to just take it in now. In case the examiner asks you that what are the sub classification of the volume variance? It is what? Efficiency variance and capacity variance. Addition of this efficiency and capacity will give you the what? Will give you the volume variance. So based on what you said the other time, that they just told you about the fixed overhead what? Fixed overhead cost variance and let me look at it again. Oh, is it different from capacity and other one? Yes. Yeah. You see, the one they taught to fixed overhead cost variance. You see, the cost variance is the major variance we are dealing with, and it's divided into what? Expenditure and volume. Go and check your notes again. The examiner, your lecturer will tell you that would have told you that fixed overhead cost variance is divided into what? Volume variance and what? And expenditure variance. It should have even told you again that fixed overhead volume variance is also subdivided into what? Fixed overhead capacity variance and fixed overhead efficiency variance. I hope you're getting it now. So you can be asked to compute all these variances. I guess that is why I'm actually sounding it now. You should add this to your note that the fixed overhead cost variance is the one we subdivided into fixed overhead what? Volume variance and fixed overhead expenditure variance. While the volume variance is also subdivided into what? Into the efficiency and capacity variance. And note, the addition of the efficiency and the capacity variance is what will give you the what? Fixed overhead volume variance. I hope you get that. Okay. That's the position. So you can add it to your notes, please. Now, that's that. Now we want to look at the second aspect of the fixed overhead, which is fixed overhead expenditure variance now. If you are looking at the fixed overhead expenditure variance, we are actually looking at the difference between what? The budgeted fixed overhead cost and the actual fixed overhead cost. So what do I mean by this? Now, let's say, for instance, you are running a bakery business. And at the beginning of that period, you have set a target, a standard, a budget that amount you are going to pay for your rent, which is the fixed overhead cost, should be 1 million naira. That's your budgeted fixed overhead cost. But eventually, after you have now started production and all that, you now realize that what you actually paid for your rent is now 1.4 million. That's your actual fixed overhead cost. But the one you budgeted was what? 1 million. So if I budgeted 1 million and I now incur 1.4 million, will you now say it's favorable? No, it's adverse because I'm spending more than what I envisaged to spend. I hope you're getting me now. Therefore, if you are finding your fixed overhead expenditure variance, what you just quickly need to look at is what is the budgeted fixed overhead cost and what is the actual fixed overhead fixed overhead cost. What is the budgeted fixed overhead cost and what is the actual fixed overhead cost? The difference between that two is your what? Is your fixed overhead expenditure variance. If you look at it, if your actual fixed overhead cost, what you actually incur in fixed overhead, if it exceeds or more than your budgeted fixed overhead cost, that's adverse. because you are spending more than what you wanted to spend. Like this one now is advert because what I actually spend actually to go 54,600, but what I say to sell is just 40 times 1,000, which is 40,000. The concern now is that how do you get this projected fixed overhead cost? Let us quickly look at it in the exam. In the exam, if you are looking for the projected fixed overhead cost, look at the way you look at it, please. Now, where is the fixed overhead? This is standard fixed overhead, right? And what is the cost? This 10 naira is not a cost, it's a rate, but the cost is 14 naira. Are you getting me? It means that to produce 1 unit of that product, you will need fixed overhead cost of 14 naira per hour. I hope you're getting me now. So this is the fixed overhead 4 hours at 10 naira per hour, which is 14 naira. But how many do you actually budgeted to produce of the product? I budgeted that all things being equal, we are going to produce what? 1,000 what? Sorry, networkless. Now, the standard cost of the material, the standard the budgeted fixed cost per unit happens to be 14 naira. That's what you budgeted to incur on one product. Then how much is now your budgeted fixed overhead cost? For budgeted production, I mean 1,000. I budgeted to produce 1,000, and the cost I am to produce one is happen to be 40. Now that would be 40 times 1,000, which is 40,000 naira. How much did I actually incur in fixed overhead? Then you now look at it deeply, that during the period, I now actually incurred 54,600. That is what we mean by what? Actual fixed overhead cost. So in a nutshell, if you now get to fixed overhead cost, budgeted cost, you now say fixed overhead expenditure variance is that what? Budgeted fixed overhead cost, which is 40 naira cost per unit times 1,000 units minus actual fixed overhead cost is how much? 54,600. So the difference between these two now, I guess, because if you look at it, the actual fixed overhead cost is 54,600. The difference between these two is 14,600 what? Adverse. It means that I am spending more than what I am said to spend. I hope you're getting that now. So that's that for that. Now, one minute, please. Now, let us now go to what? Sales price variance. If you are looking for sales price variance, what are these? What are you looking for? You are looking for the variances in what? In price of material. Don't forget, price of material is different from what? Price of material is different from the price of what you are selling the product. Material is flour, the product is what? Is bread. I guess what I'm saying now. So it means that if you are looking for sales price variance, you are looking for the sales price variance in the price of the bread. It's equal to actual quantity sold into standard selling price minus actual selling price. How much do we want to sell the product? How much do you actually sold the product? That means I want to sell for 250 naira. We now eventually sold it at what? At 240 naira. What's the difference? The difference is 10 naira times 1,200, which is the actual quantity they sold. That gives you 12,000 12,000 adverse. That is that for that. But the last one there is what is sales volume variance. If we say sales volume variance, what do we mean? You are looking for the variance in the volume of productions. That means that what do we budget to produce and what do we actually produce? I get what I'm saying. Or what do we budget to sell and what do we actually sold? That's the sales volume variance. You will be looking at it from what we sell. I get what I'm saying. Look at it. Sales volume variance is equal to standard profits into budgeted quantity minus what? Actual quantity sold. How much is the standard profit they make? That's how much is the profit they set to make at the beginning of the period. Standard profit into budgeted quantity. How much was at the budgeted to produce and sold and actual quantity sold. So that means that what? If you look at it, standard profit is how much? Let's check the standard profit. Look at standard profit. Standard profit is what? Is 108 naira. Standard profit is 108 naira. You can see the profit is set. That's standard profit 108 naira. Then how do we still get the what? The sales volume variance. You now see sales volume variance is now standard profit, which is budgeted quantity 1,000 and actual quantity sold, which is 1,2. What we have is what 21,600 favorable. Can you not see how we get the sales volume variance? Standard profit is the budgeted quantity and its actual quantity sold. Now, let's go on from here. Let us now look at how do we reconcile now. We have computed all the variances. Reconciliation statement of budgeted profit and what with actual profit. Now, how do you reconcile? Now, you know, at the initial stage, we had in mind of what profit we are going to make. Is that not? We have in mind that this is the profit we are going to make. And you now realize at the end of the day, the profit you actually made will be different from the profit I envisaged to make. I hope I get what I'm saying now. Now, if you look at it, how much was the profit we envisaged to make? Let us first go and get it in the standard cost information. So you envisage to make the following 108 naira per one, and we budgeted to produce 1,000 dreamers. That's 108 times 1,000. That is what? That is that. That's budgeted profit. Now look at the budgeted profit now. It should now be 108 naira times how many units they budgeted to produce? 1,000 units. That's 108,000 naira. So it means that the budgeted profit, how much profit they are looking at making at the beginning of the period, they will have said that is what is 108,000 naira. But how do we know whether the actual profit is higher or lower than this budgeted profit? Because the difference between the budgeted profit and actual profit is what is the difference of what brings about that variances now. It wasn't bring about all the variances we have computed so far. Because if you look at the difference between actual profit, that difference is what leads to all the material labor overhead and overhead variances that were computed. Therefore, you must be able to find a yardstick of what of confirmations. I hope you are getting me now. Please give me 1-2 minutes, please. 2 minutes. I'm sorry. So, sorry. Yeah, thank you. Now look at it. Now reconciliation statement. Now we wanted to make 108,000 naira profit. That's what we wanted to make. But what do you now actually make? Because you need to go and get how much is now your actual profit you made. Now let us go and get our actual profit made. To get our actual profit made, you will now use what we call the actual information. The actual information is what you now use to determine your actual profit. How do you get the actual information? That's the actual sales minus actual cost. But don't forget, if there is any closing stock remaining, you have to be able to value the closing stock before you can get the actual profit. That's what they mean by reconciliations. That's you only to get the actual profit. Whatever you get in actual profit, that's when you are using to compare the budgeted profit. I guess what I'm saying now. So let us look at it, please. Actual sales now. How much did they actually sold? They sold 1-2 at what? At 240. Because if you check it, they told us in the question that what they sold or actually want to do, they produce 1-3. So you need to what? You need to understand what they are saying. They produce 1-3, but they sold 1-2. You can see they produce what? They produce 1-3, but they sold 1. I guess what I'm saying. Now, they have gotten the actual sales now, actual selling price and actual profit, actual quantity. That's our actual sales. So now, apart from that, you now say, what's that? You now less all the actual costs from it. So what are the actual costs that we are lessing now? What's the actual cost? That's actual cost of material, actual cost of labor, actual cost of labor overhead, actual fixed overhead cost. Because if you look at it, all the actual information there, you can pick it from here. Look at the actual information. Actual cost of material is 16,000 times 1. At 1 hour. Why actual cost of what of labor is 5,006. Sorry, the network. Now, as I was saying, if you look at it, after getting all these costs together, the variable overhead, the fixed overhead, you now say less closing stock. How much is the closing stock? You now go and look at what they sold and what they produced. I guess what I'm saying now. The difference between what they sold and what they produced is your closing stock. That's what it did not sell for that period. Therefore, if you see it, they produced 1.3 and they sold 1.2. I guess that means that 100 units will be a closing stock, which you have to be removed. But how do we value this closing stock? Because the 100 units is in unit already. I guess and you need to value it using something like is that material cost or labor cost or the combination of all these costs. I guess so if you have this kind of situations, you now say closing stock is 100 units, right? Times how much is the standard material, standard cost? Look at it. Just give me 1 minute, please. Now, so based on the stock valuation of closing stock now, that's what we are trying to value. So that because if your production is not equal to sales, you need to value closing stock, and that's what we are trying to value now. Look at it. Closing stock is 100. That's 1.3 minus 1.2, which is 100 times the standard cost of productions. You know why we are multiplying by standard cost? Because you will have put material there, labor is here, variable overhead is here, variable fixed overhead is here to make that product. Are you getting me? So they must have incurred those costs on that particular 100 units. Therefore, if you want to value it, you need to value that 100 units using the standard cost of productions. And what was standard cost of productions? It was 152, 142, because if you look at standard cost of production, it was actually 142. Where is it? Can you see standard cost of production, cost of sales? Standard cost of sales is 142. So you value the 100 using what? 142 naira. So after getting that now, I mean, 14,002, not even 142,000. 100 units times 142 is 14,002. If you move it from 182,500, you have 168,300. Then that's the cost of what? Cost of sales. Then you now what? You move it from the actual sales of 20,000. You have what? Actual profit is now 119,700. Can you now see? It means that the profit they actually made for the period is 119,700. Then what's the profit they're supposed to make? They wanted to make 108,000. I hope you're getting. They wanted to make 108,000. They now made 119,700. Note, the closing stock was valued at standard cost of 142. Can you see? They now explain there. That is the addition of standard material, labor, variable overhead, and fixed overhead cost. Those are the costs you use to also value the words to do the valuations of the closing stock. Therefore, profit difference of actual profits and budgeted profits. Here it was 190,700. Why the budgeted profit was what? 108,000. If you move 108,000 from 190,700, you have 11,700 favorable because the actual profit is actually more than the projected profit. It means that we are doing wonderfully well if we have this kind of indices in the organizations. It means that there was profit difference, which is because of actual profit minus retained profit, is what is 11,700. So all the variances that were computed, they must be equal to 11,700 favorable. All the variances that were computed. If it's not equal to this, then it's as if you want to make a mistake or you want to repeat. So that's that. So let us confirm this. Let's confirm it, please. We want to confirm this 11,700 favorable. We want to see whether that 11,700 is actually equal to what, to all the variances that were computed. Now, if you check it very well, this is what you do. You now need to write it out. This is favorable and this is adverse. Now, which one are the favorables? Which one are the adverse? Now, let's start with the material price variance. For the material price variance, is it favorable or adverse? Is what is favorable, 1,600. You go and check it check it, material price variance in our computations. Can you see? For material price variance, we pick it one by one. For material price variance is favorable. Look at the 600 favorable, 1,600 favorable. I said I omitted one there. Material usage variance is what? 600 adverse. So you start picking them one by one. 1,600 favorable, 600 adverse. Let us quickly pick it and put it there. We are trying to reconcile 1,600 favorable, material usage 1,600 adverse. Labor rate variance is 0 because we have 0 variance. So the manager is good. Now, labor efficiency variance is 1,200 favorable. Variable overhead efficiency variance is 3,000 favorable. Variable overhead expenditure variance is 500 adverse. Fixed overhead volume variance is 12,000. Now, don't forget, I don't need to now repeat capacity and efficiency again under fixed overhead. No. Because addition of the capacity overhead capacity and fixed overhead efficiency is what leads to fixed overhead volume variance. So if I put the volume there, then I will not put the capacity and efficiency. But if I put the efficiency there, then I will be able to what? If I put the efficiency there and capacity, I will not pick the volume there. So in this instance, the one I approach is what is volume. Fixed overhead volume is 12,000. While fixed overhead expenditure is what? Variance is 14,600 adverse. Why sales price variance is 12,000 adverse? Sales volume variance is 21,600 was favorable. Then if you add all the favorables together, it's giving 39,400. And if I add all the what? Adverse together, it gives you 27,700. So therefore, the difference between this 39,400, you can use your calculator on that. The difference between 39,400 minus 27,700 is 11,700 favorable. Can you see? 11,700. I hope you know the reason why it's favorable. What we said, the favorable are 39,400, which is more than the adverse 27,700. So favorable will take the sign. So that is that for the work for the confirmations. So you can now take time out and look at these questions and see what you can lay your hands on. I hope you're getting me now. So that's that for that. You can lay your hands on it for your convenience. That's that. Any questions? Please ask me questions. Even if you have any secular questions or questions in class you have issues, just let me know. No problem. No problem. I will send it to you. Don't worry. It will be sent to you. I will do as you asked. Who else again? Any questions again? Any question again? You can ask me any questions. No problem. I will try to send it this night. No problem. Well, any other questions? Now, if there is another question, let me quickly open another one. Okay. I will ask the other colleague of mine to look at the economic order quantity. Yeah? I'll ask him. Okay, on the group, Abi. Okay, Tony, I heard. Well, listen, I heard, Tony. I will look at it. No problem. Okay, you don't mind if I have it on the group? Okay, problem, please. Let me ask you a question. Can you see my screen now? Can you see my screen?
Yes, sir. We can see your screen, sir.
Okay, thank you. Thank you, I appreciate it. Okay, thank you. Now, let's quickly look at this. Cash budgets, cash budgeting, or we can call it cash budget. Let's look at cash budget. So what about if the examiner now come for cash budget and I ask you to prepare a cash budget? What is even a cash budget? A cash budget is a detailed plan of cash receipts and cash payment. It's a detailed budget of cash receipts and cash payment during a planning period. Now, the planning period is subdivided into shorter period, and the cash receipts and payment are forecast or planned for each of the subdivision of time. Now, the cash budget might be prepared on a monthly basis or possibly a quarterly basis as part of the annual master budget. But many businesses also prepare cash flow forecast for shorter periods. For example, the next week or weekly cash flows for the next month. So what we are saying in essence is that a cash budget is a budget that you prepare to show the liquidity position of organizations. If you want to show how liquid an organization is, it means that when I say liquid now, I'm actually talking about how well an organization is able to meet up with its everyday obligations. I hope you get what I'm saying now. How well would an organization be able to meet up with everyday obligations? That is when we say an organization is liquid. So it means that if you are liquid, fine, it's good because you'll be able to meet up with everyday obligations. But if you're having a problem with liquidity, it means that it can rub off on your profitability. That means that you are having issue in what? In meeting your everyday obligations. So cash budget will help us to understand the meaning of what? Of how an organization can meet up with its everyday obligations. I hope you're getting me now. Now, that's that. But what are even the main uses of this cash budget? Why do we prepare the cash budget? What's the reasons why cash budget is prepared? How much cash receipts and payments are expected to be. We want to see at a glance how much will the cash receipts and payments are getting over the planning period. How much are we expecting to come in, and how much are we expecting a shortage of cash at any time during the period, or possibly a cash surplus. We'll also use cash budget to show whether you are going to have a cash shortage or surplus. so that if you have a cash shortage, you'll be able to prepare in advance how you can get liquidity from a finance arm or from a bank. But you need to know how you can productively engage the surplus cash, and you don't keep unnecessary cash beyond what is needed in organizations, because it is what it is very dangerous, and it is contrary to the growth of whatever. It can affect the growth of the organizations if those cash are not well managed. I guess if there is a forecast shortage of cash, to consider measures in advance for dealing with the problem. It means that if you're not having a problem of cash in advance, you are going to have a problem of cash. You'll be able to know in advance due to the cash budget, so that you can plan towards handling that shortages, and also to monitor actual cash flows during the planning period by comparing actual cash flows with the budget. It means that it is also used to monitor actual cash flows during the budget. All these are what you need to know about the uses of the cash budget. I get me. So let us look at the question in your past questions, recent pattern of sales or what of fast moving consumer. Now the following data are projections for a period of 6 months. Now, before you even go into this computation or anything, how do we even obtain? I hope I get what I'm saying for the period. Please note, when you are preparing your cash budget, you don't include what depreciations. I hope I get what I'm saying. Now, depreciation is not a cash movement items. So therefore, depreciation should not be in your computations. I hope I get what I'm saying now. So another thing you need to know about this cash budget is that when you are preparing a cash budget, provisions also should not be also inclusive in what when you say they provided for this, they provided for that, and all that. It's not relevant in what's a cash budget. And also one thing that is very simple about the cash budget is that is the way they collect the cash. You will be given different scenarios of how the cash is being collected. They will tell you that collect 10% in the month of sales, 50% in the next month, at the remaining 40% 2 months time. That's a policy. I guess and if they give you a question in that nature in the exam, you have to go by the policy of the organization in questions. I guess so that is that. So what do you now do under the cash budget? You just look at what is it that is coming in and what is it that is going out in expenses. You now remove the expenses from the income. For what comes in, you now say you have a net cash flow. I hope that's what I'm saying. So net cash flow, which simply means it is the bundle of the income that is coming in, I get me, and what is going out. So when what is coming in is more than what is going out, I get what I'm saying now. In terms of cash movement, then you say you have you have the surplus cash. But if the other way around, you have a deficit cash budget. So that is it about cash budget. It's just talking about how do you receive cash and how do you pay cash out. At what point are you going to be breaking even? At what point you're having excess in your hand? At what point you're having shortage in your hand? What's the impact of it on your customers? All these are the content that you need to look at under the word cash budgeting. Now, let's look at the questions so that I can use to portray it. Though we don't have time again, but now let's look at it. Just want to first read the questions. So, look at it. Why Me Limited is engaged in the manufacturing and sales of fast-moving consumer products? The following data are projections for a period of 6 months. They give you projections for how many months? How many months? 6 months. And as you look at the projections, sales. Sales, if you sell, money will come in, that's an inflow. If you purchase, money will go out, that's an outflow, So sales for January, February, March, April, May, June, given. Purchases for each of the months, given. And sorry please. 1 minute. Now, we have the following data are projected for a period of 6 months. Okay, we have January, we have February, March, April, May, and June. Now we have sales. These are our sales for each of these months. Purchases. When you sell, money comes in. When you purchase, money goes out, right? Salary, gross. When you say salary gross, it means that they have not removed deduction from it. This is gross for each of the months. Staff salary deductions. This is what they will deduct from each of these salaries. Overheads are this. These are the information you are given. The now say other additional information are as follows. What are the other additional informations? Now say sales are 25% on cash basis. It means that whatever you sell, you collect 25% of it instantly. 55% is collected in the month following sales, and the balance in the what? In the third month. That means that whenever you sell, 55% of it will come in the month following sales, and the balance in the what? In the third month. I guess me now. So it means that that's how. What's the balance now? The balance will now be 55 plus 25 is what? Is 80. The balance is 20%. 20% is what will now come in the third month. That's one. Two, all purchases are on 30 days credit. Why 20% overhead? All purchases are on 30 days credit. It means that they give 30 days credit. That's 1 month credit. I guess for all purchases. So all purchases are on 30 days credit. Since our customers are ready to give us 30 days grace period before we make our lodgement. Now, we now say why 20% of overhead will be paid in the same month and the balance in the following month. 20% of the overhead will be paid in the same month and the balance in the following month. So that's that. What does that mean? 20% of our overhead will be paid in the same month. Whatever our overhead is, I'll pay 20% of it in the month they incur it, and the balance I'll pay it a month after. That means that in January now, 20% of what overhead in January will be collected will be paid in January, while the remaining 80% will be paid a month after, which is in February. And that's how I say it should go. Now, salaries will be paid net in the same month. When they say they pay salary net, they must have removed the deductions. While the statutory deduction, that deduction they remove will be remitted on the 10th day of the following month. It means that deductions now will be remitted. That's when they will pay it on the 10th day of the following month. Now, also a 10 million naira loan applications to the company. A 10 million naira loan application to the company. They gave the company 10 million naira bank loan will be released in March to finance the purchase of a new asset, which is costing what? Which is costing, what is it costing? 12 million naira in the same month. Now, the repayment of the loan will be spread equally over 4 months, starting from April. April. Ignore interest on the what? On the loan. So please note that the payment of that loan will be spread equally. If the loan is 12 million, how do you spread it? You spread it what? Equally 4 months, equally over 4 months, starting from April. It means that you spread it equally over 4 months, starting from April. That will be April, May, June, July. You have to adjust that. Now, the last one is what? An old asset to be disposed of in the month of April for 1.5 million naira. It means that will come in the month of April, but that will be disposal. The cash balance as at the end of February will be 6.5 million naira. It means at the end of February, we will have 6.5 million naira, out of which 2.5 million will be put in a short-term investment with the bank in March at an interest rate of 2%. You have a short-term investment in bank of 2% monthly to be credited at the beginning of the month following the investment. You are required to prepare the cash budget for the period of March towards May. Now look at this. Let's first pick the sales. But when you sell, money comes in, right? That's an inflow. they said, how much did they collect? How did they collect the sales now? Sales are 20% on cash basis. That's on cash basis, 20%, 25%. Why the 55% collected in the month following sales and the balance in the what? In the third month. That means that we're having 25%, 55%, which is 80%, and 20%, which should be the one that will go to the third month. So let us even look at how that will play out. Let's see how that will play out. Let's look at the sales. These are the sales for each of these months. From January to February, March, April, May. These are the sales. But they said you collect 25% in the month of sales, 55% in the month after. Why 20% in the third month? Now look at it. We now use your calculator. Now use your calculator. Let's start with this 9,600 of January. 9,600 of January will be paid when? In January. Right? We don't need it. 25% of it will pay in January. We don't need it. In February, 55% of this 96, which is a month after the January, will be paid in February. Right? Why? We don't need it because we don't even need February. We start for March. Why the last percentage there will now be the one that will make it 100%, which is 20%. Now, means that 20% of 96 will now come in what? As 1,920. Can you see the way things are being run? Look at it. We are dealing with January 1st, this January. 25% of what you sell in January, what you sold in January, and we collected in January, that's understandable. 55% of what you sold in January again, we collected in what? In February. That's still understandable. But 20% of what you sold in January, I get what I'm saying now, will be collected in when? In March. That's when you have what? You have 1,920, under 20%. Now, I need to now look at it this way. The February now. How do you collect the February? You collect the February by going by the percentage again. What's the percentage you are given initially? Percentage at 25 and 55 and 20. Okay, let's go and check it. 25 and 55. Now, for the February sales, which is 15,800, 25% of February sales will drop in February. I hope you say agree with me. 25% of cash sales is in cash. 55% of February sales, where would they drop it? They'll drop it in March. I guess because a month after, this 55%. We drop it in what? In March. 55% of 15.8, you can do it. $8,690. Can you not see? It means that 55% of 15.8 is how much? 8,690. Can you see? Now, 20% of 15.8, 20% of 15.8 will now be paid in when? In April. That means that it will now be 3,160. So that's what corresponds to 20%. 3,160. I hope you are getting me. So that's the way you move it. I get me. So we have done January, we have done February, and we have seen the way they move. So March now we now do. For March, what is the total percentage of sales collection in March? 25% of 16 million. will be a cash sales, right? Which should be paid in that what? In that month. Let me confirm that 0.25 times 15 million. I hope it's 15 million. 15 million. I want to come in. This 16 million. 16 million, the 25% of 16 million, 0.25 times 16 million. That's 4 million. So that's 4 million. Can you see the 4 million there? This 4 million, there's 1,000 on top, that's 4 million. It means that 25% of this 16 million is 4 million. Now, what about 55% of this 16 million? Where will it go to? It will go to April, which is a month after. That's why we say 55% of 16 million will obviously be what? Will obviously be 88. That's 55%, 0.55 times what? Times 0.55 times 16 million. 16 million. That's 8,800. You can see it's 8,800. You understand what I'm saying now? So that's it. So 8,000. Now, what's about the 20% remaining? 20% of what? Of this 16,600, I guess it should go to what? To the third one, which is May. That's what we have as 32. 20% of that March sales. That's 0.2 times 16,000. That's 3,200. That's 3,200. Can you now see? So let me do one more. April. In the April, how much total sales in April? 17.6. But you know that 25% of 17.6 will be what? Will be paid, will be received in that month. That's 4.4. It's a 0.25 times 17,600. That's 4,400. Then 55% of 17,600 will be what? Will be 9,680. That's a 0.55 times 17,600. That's 9,680. That's why you have 9,680. Can you see the way we move it? The way those payments are being made and all that. So it means that you need to be very careful when you are moving those percentages. It's very important. Please, this is where we are going to put a stop to it today. Wow. Wow. I will check my schedule and I'll relate to the other lecturer. I guess now, whatever we need to do to still assist you, we'll surely do. I guess now. But look at the submissions here. Just follow suit. If you check the format here, that submission proper, you can see the inflow, you can see the outflow. The inflows involves all the collection, both sales, loan, fixed asset disposal. If they dispose of an asset, money will come in, and also investment income. So those are its inflow. Outflow is what you spend. I guess so at the end of the day, you use what comes in and what goes out as the basis for determining what's the value you have. I get what I'm saying, whether you're having surplus or what or deficit. Hope you're getting me now. So I will talk to the other lecturer and see what we can do. I mean, to even finish these questions, and also it will probably not be online on Zoom again, because officially they should terminate the Zoom this week. I get what I'm saying, so that we can allow the student to go and read for themselves. But let me see what we can do after discussing with my colleague on what we can also still do to assist you. We'll surely hear from us, please. Thank you. If you have any question, please ask me the questions. Any question, please ask me the questions. Any questions? Any questions, please? So I will discuss with my colleague and say anything we need to do so that we can assist you the more. Please, although feel free to chat us. Just if I chat us, DM us and talk to us on your concerns, which you are ready to attend to. Please. Thank you for your time. I appreciate you guys. My host, please.
Yes, sir.
Okay, sir. Thank you so much. You can close the class.
Okay, thanks so much, sir.